is about 40% below where we are right now. We got the analyst behind the call. That is Alex Haissl, joining us now live from London. Alex, I'm sure you've received some choice and colorful comments to your email inbox today, but you call it as you see it. We appreciate it. What is the basis of this call?
Yeah, first of all, thanks for having me on the show. The basis is really we see like big headline figures in terms of like order wins and also revenues. But our work really shows that the value subscribed to this is relatively low because the business model is fundamentally different. If you think about these deals, we're talking about single tenant deals for dedicated clusters where, you know, the price and also the costs are pretty much fixed over the contract period. This is a sharp contrast to what we know from, you know, the cloud 1.0, that we know it and investors really price it, where you have basically sweated the asset over time. You have extended server lifetime. The hyperscalers then layered software on top. And all of a sudden, you know, in the cloud, you had a business model with operating leverage and software-like margins. This is not what we are seeing here in terms of like these large-scale strategic deals where we have like big headline figures, but actually the value is significantly lower.
Do we think that the market is pricing in not only all the good news, but the single most optimistic scenario that everything that we've just been talking about ultimately plays out and then some?
That's exactly what it is. I mean, we titled it, it's a risky blue sky scenario. So we think, you know, the 5-year guidance is worth around like 60 billion. And then the question really is, how often do you have like a renewal cycle of these 5 years? So the market is pricing in already a very optimistic scenario and completely overlooks the risks.
Yeah, do you question the stuff that we've all just talking about? A lot has been made this week in particular about this so-called idea that there's a lot of circular money. It's this invests in A, invests in B, invests in C, which invests back in A. Do you worry about that?
I mean, from an Oracle perspective, our concern that we raise is that is Oracle signing like long-term leases for data centers, you know, where you have a duration of, let's say, 15 years. But then on the other hand, you only have a 5-year contract with OpenAI. So there is a duration mismatch. And I think that's one of the concerns that we really have. At some point, someone has to take these costs.
Yeah, and then you may have heard our bond report just a moment ago, Alex. As you know, Oracle issuing billions in debt. They want to pay for a lot of this with debt, not with cash flow. Does that worry you at all?
I think what is a concern is that the market is very likely to underestimate the capex requirements. You know, for Oracle to hit their 2030 target, we think that they have to spend significantly more than what consensus is expecting. And we are just at the early innings of this capex cycle, and we have already seen negative cash flow. So as the ramp continues, obviously there's more capital being required the closer we get to the bigger, you know, ramp.